Silver is the most misunderstood asset on Earth, not because it's complicated, but because nobody explains it correctly. Most people think of it as cheap gold, a second-tier precious metal for people who can't afford the real thing, something you buy in coin form and forget about. That picture is wrong. And understanding why it's wrong changes how you see an enormous piece of the modern economy. Let's start at the beginning. Silver has a property that no other element on Earth shares at the same level. It conducts electricity better than anything else, better than copper, better than gold. It's also the best thermal conductor of any metal. It's naturally antibacterial. Bacteria cannot develop resistance to it. And it can be shaped into layers so thin they're invisible to the naked eye without losing any of these properties. This is not a precious metal that sits in a vault looking important. This is a working material. And every major industry that makes the modern world run needs it. Your phone contains silver, not as a decoration, as the actual bridge between the electricity and the screen, the circuits, the connections. Every electric vehicle being installed on a rooftop contains silver paste, conducting electricity through the cells. Every AI data center being built right now runs on silver contacts and circuit boards. Every hospital expanding its infection control capacity uses silver-coated surfaces and instruments. Silver is not a relic, it is embedded in the physical infrastructure of the 21st century. Now, where does it come from? This is where the first economic paradox appears. Most silver on Earth is not mined intentionally. Roughly 70% of all silver produced globally arrives as a byproduct. Miners dig for copper, they find silver. They dig for zinc or lead, silver comes along. Nobody built the mine because of silver, they built it for something else, and silver is separated out during the refining process because it's there. Only about 30% of silver comes from mines that were specifically built to chase silver. What this means economically is profound. You cannot increase silver supply by deciding to increase silver supply. The mines that produce most of the world's silver are making their decisions based on copper prices, zinc prices, lead prices. If copper demand falls and copper mines slow down, silver output drops too, regardless of what silver itself is doing. And building a new dedicated silver mine from scratch? You're looking at a decade from discovery to first production. There is no fast lane in geology. So supply is slow, structurally rigid, tied to industries with completely different economic logic. Now look at what's happening to demand.
The world is currently in the middle of three simultaneous technological transitions: clean energy, electric transportation, and artificial intelligence infrastructure. All three are heavy silver consumers. None of them existed at meaningful scale 20 years ago. Solar panels alone have gone from a minor consumer of silver to one of the largest. And here's the important nuance. Engineers have worked extremely hard to reduce how much silver goes into each panel. They have succeeded dramatically. The silver content per solar cell has dropped by roughly 80% over the past decade through better design and manufacturing. And demand from solar has still nearly tripled because the number of panels being installed grew so fast that the efficiency gains couldn't keep pace. Governments have made legally binding commitments to solar capacity targets that require installing enormous volumes of panels over the next 10 years. That demand is not speculative. The capital is allocated, the projects are in permitting, the factories are running. Electric vehicles add another layer. An electric car uses roughly twice the silver of a conventional combustion vehicle. Every EV on the road is a permanent increase in the baseline demand per vehicle, locked in for the lifetime of that car. As the global fleet transitions, that multiplication effect compounds every year. And then there's artificial intelligence. The server infrastructure being built to run AI models, the chips, the boards, the connectors, all of it runs on silver. The scale of investment in this infrastructure right now is larger than anything the technology industry has built before. So you have a supply that moves slowly and a demand that is being pulled forward by forces that governments and corporations have committed trillions of dollars to. The result is a structural deficit. For 6 consecutive years now, the world has consumed more silver than it has produced, every year. The gap has been filled by drawing down stockpiles, silver that was accumulated in previous decades. Those stockpiles are finite. They have been declining steadily. The buffer that exists between the market functioning normally and the market experiencing a genuine physical shortage is thinner than it has been in decades. In October 2025, the world got a preview of what happens when that buffer gets thin enough. Physical silver in London, the global center of the silver market, became nearly impossible to borrow for short-term delivery. The cost of borrowing silver, which normally sits below 1% annually, spiked to almost 40%. A market that had appeared well supplied for years suddenly couldn't source the physical metal. Prices hit all-time highs. The squeeze lasted weeks before metal flowed back from other locations and stabilized the situation. That event was not a manipulation or an accident.
It was a structural consequence of years of deficits draining the available physical inventory. Now, why has the price historically been low given all of this? This is the most important economic question in the silver market. And the answer has several layers. The first layer is how the price is actually set. The price of silver that you see quoted everywhere is not established by buyers and sellers of physical silver exchanging real metal. It is set on futures exchanges, primarily in New York, through paper contracts. Agreements to buy or sell silver at a future date between parties who overwhelmingly never intend to touch actual physical metal. They are trading exposure to the price. Think of it like a parking garage that sells 100 tickets for 13 available spaces. As long as nobody shows up at the same time expecting to park, the system functions. The ticket price is set by how many people want tickets, not by the actual number of spaces. The silver market has historically operated with a similar dynamic. Enormous volumes of paper contracts trade against a much smaller amount of physical metal. As long as almost nobody actually asks for delivery of real silver, the paper price holds. The problem is that this paper market is where the global reference price gets established,
which means the price of real physical silver, bars in vaults, silver in industrial supply chains, is anchored to a market that has historically been dominated by financial participants trading paper with no connection to physical reality. When physical demand tightens faster than the paper market acknowledges, you get the kind of dislocation that happened in October 2025. The physical market and the paper market tell different stories. The physical market eventually wins, but it takes time and the correction can be violent. The second reason silver has historically priced low relative to its fundamentals is institutional. Central banks around the world accumulate gold as a reserve asset. They have been buying gold aggressively for years, thousands of tons annually across the global central banking system. They do not accumulate silver. There is no sovereign institutional buyer creating a structural demand floor under silver the way there is for gold. Gold has a buyer of last resort at the nation-state level. Silver does not. This matters enormously for price. Gold's monetary demand, the demand from governments and central banks treating it as a reserve, adds a layer of institutional price support that silver simply doesn't have. Silver's price has to be supported entirely by industrial demand, retail investors, and financial market participants. When those groups become uncertain, silver falls harder and faster than gold. This is why silver is sometimes called the devil's metal. It can double in months and lose 30% in a day. Both can happen from the same underlying position. The third layer is the gold-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold, and it tells a very strange story. The Earth's geology produces roughly 7 or 8 ounces of silver for every ounce of gold. That is what the ground actually yields. For most of recorded monetary history under the systems that governed Rome, the Byzantine Empire, medieval Europe, and early America, the legal exchange ratio between silver and gold was fixed at roughly 15 or 16 to 1. The United States maintained a legal bimetallic ratio until the late 19th century. Today, the market prices them at roughly 55 to 1. The market says silver is 55 times less valuable than gold. History said 15 times. Geology says 7 or 8 times. None of those numbers are the same. The gap between them is not random noise. It reflects specific structural reasons: the absence of central bank silver buying, the dominance of the paper market and price discovery, the fact that silver is perceived primarily as an industrial commodity rather than a monetary asset. But that gap is also the argument that silver is systematically undervalued relative to gold. Every time this ratio has reached extreme levels historically, it has eventually compressed back toward historical norms, not because of speculation, because of the underlying reality of what these metals actually are relative to each other. Now the substitution question, because it's the most honest counterargument. If silver becomes too expensive, can industry find alternatives? In solar energy, this is genuinely happening. The copper transition in certain solar cell architectures is real, led by major Chinese manufacturers. Copper is 100 times cheaper. If it works at scale with equivalent long-term durability, it reduces pressure on silver demand from solar specifically. But copper corrodes. Solar installations are warranted for 25 to 30 years. The long-term field performance of copper metallized panels across those timeframes doesn't yet exist at scale. The transition is real, but partial and technically constrained. In electronics, medical devices, electric vehicles, and AI infrastructure, the case for substitution is weaker. Silver's combination of conductivity, corrosion resistance, and reliability in precision applications at small scales is not cleanly replicated by alternatives at comparable cost and performance. So where does this leave us? Silver is the only major commodity where you can simultaneously say the demand is being structurally driven by the three largest technology transitions of the century. The supply cannot respond quickly because most of it is a byproduct of completely different industries. The price is set by a paper market that historically trades at many times the volume of physical metal. Central banks support gold but not silver, and the physical market is already showing signs of structural tightness after 6 consecutive years of deficit. Is silver the new gold? No. It is something more complicated and in many ways more interesting. Gold is the asset people run to when they stop trusting the system, when currencies look fragile, when governments look unstable, when the future looks uncertain. Gold doesn't do anything. It just holds value in a world where everything else might not. Silver does the opposite. Silver is what you need when you believe in the future, when you believe solar farms are going to be built, when you believe electric vehicles are going to replace combustion engines, when you believe AI infrastructure is going to continue expanding. Silver is embedded in the physical construction of that future. That is a completely different economic argument than gold, and it's one that the price, relative to gold, relative to history, relative to the actual demand being built into the global economy right now, has not yet fully reflected.